question. Thanks for the information, very insightful. You're welcome. What do you think of buying a property cash, then taking out the equity? Good question. Once again, I am going to show you what I think about that rather than tell you, because I'm a visual learner and I think it comes across a lot better and clearer using an example. So here is another spreadsheet, and again, don't get overwhelmed. I'm going to go through this line by line. So let's first of all look at what it looks like to buy the property via a mortgage, as most people do, as opposed to a cash purchase, and compare and contrast what that means for your equity and your return. So in this example above, the kind of brown burgundy colour, let's say year one, you're buying a property for £100,000, and usually with a buy-to-let property, you have to put down 25%. So your deposit in column C is 25%, and your mortgage is 75%, which is £75,000. That's what the bank lends you. So 25 plus 75, £100,000. You bought the property, all good. Now, year two, let's say your property grows by 6%. The average growth of properties in the UK over the past 15 years has been 6% per year, believe it or not. So that's what I'm assuming throughout. So year two, it's worth £106,000. Your deposit that you put in is still £25,000, and that carries on for as long as you own the property. That's always going to be how much you've put into the property. I'm assuming that. Now, if you was to remortgage in year two, and usually people remortgage to draw equity, because that was the second part of your question, out of the property, you could remortgage at £79,500. Why that number? Because it's 75% of £106,000. So when you remortgage, lenders tend to give you usually around about 75% of what the property is worth, i.e. the increased value, 75% of that. So what you will do with that £79,500 is repay your original mortgage of £75,000, and you keep the remainder, which is £4,500. Tax-free, in your pocket, do what you want with it. That's how it works. That's what I've done with my last 2 properties in the last 12 months, okay? I've drawn out just over £40,000 doing this. So in terms of a return, okay, you've put in £25,000 and you've been able to draw out £4,500. 18% return. Not bad, hey? And of course, as you go forward in time, as you hold the property for longer, the value goes up more and more and your equity increases. So let's fast forward to say year 15, and it's been growing at 6%. It's been carrying on growing at 6% per year. So now in year 15, it's worth £226,090. And say at this stage, you decide to take out some equity. So you can get the mortgage lender to give you 75% of that £226,090, which is £169,568. Out of that, you repay the £75,000 original mortgage. So you're left with £94,568 in your pocket. Tax-free, free money. All you've done is just hold on to the property and watch it grow over time. And then you can access the equity that's built up over time. That is a return of £378,000. Now, let's compare that, okay, to doing it with cash. So no mortgage involved. You just buy it cash. So day one, year one, you buy the property for £100,000. I've just put the deposit as £100,000 because, well, that is how much you're depositing into the deal. No mortgage. You own it outright, okay? No mortgage. £100,000 in. That's compared to £25,000 when you use the mortgage. So you're putting in more money, but you own it outright straight away. Now, let's fast forward to year 15. We just saw above, the numbers are all the same, essentially. It's grown 6% per year over 15 years, so it's worth £226,090. But your equity this time is £126,000. So you are getting more money out compared to £94,568. But look at the difference between the returns. One is 378% return, one is 126% return. Why the difference? The difference is because in this scenario where you used a mortgage, all you put in was £25,000 and you got back £94,568. So you put in less and your return is a greater multiple. In this second scenario where you've paid cash, you've put in 4 times more. So you've got more of your cash tied up in this property, 4 times more to be exact. So £100,000 versus £25,000. Yes, you're going to access 100% of the value increase, which is £126,090, but your return on what you put in is 126%. So in a nutshell, the reason why we use mortgages leverage is what some people call it as well, is because you can maximize your returns. Now just imagine for a sec, right, that instead of putting £100,000 into this one property, you actually bought 4 properties, right? So if you're using a mortgage, all you need is £25,000. So you could actually buy 4 of these properties using that same amount that you've just put into one property below, using a cash only purchase. Use a mortgage, you can actually buy 4. So then by year 15, for the same amount of money that you put into a cash purchase below in blue, just one house using £100,000, you could have bought 4 properties. Your equity after 15 years would actually be 4 times 94,000, 95,000. I can't do the math in my head, but it's roughly 390,000. I think it's just under 390,000 pounds. And we're talking over 1,000% return. That is why we use mortgages. You can use the same amount of capital, but get an even greater return by using the bank's money. I hope that helped. Thank you for watching. This year, I'm making a video every month to answer any questions that you have for me. So whether you want to know whether you should invest in a limited company or in your own name, whether you should buy a flat or a house, what is the best way to get started in property, or who my barber is, just let me know. You can ask me in the comment section below, on Instagram, on TikTok, and I'll make a video dedicated to your questions. Like and subscribe, and thanks for watching.